Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is the most important interview of the day. What you got to understand is most titles in the investment business are not like some think tank thing from senior management. They're mostly decided in a Starbucks, like a 240 Greenwich downtown. She has the greatest title of anybody on surveillance, head of investment strategy in equity advisory solutions at BNY Mellon, and that can only be Alicia Levine. I have never seen the divergence of opinions. Like literally, I'm not exaggerating, never. What is your equity advisory solutions in this chaos?
So long and strong, but you're right. It has been a relentlessly frustrating year. There's a lot of fear about tariffs and policy and the speed with which unusual suggestions are coming out of the White House. I'll just call it that. And yet we just had one of the greatest earnings seasons in a long time. Earnings up about 16% for the fourth quarter. Okay? And the market's saying, what are you all yapping about? Okay, what are y'all yapping about? Don't forget.
There's a lot of yapping.
There's a lot of yapping. We yap. But it's earnings, it's growth, and it's margins. We know this, right? And it's interest rates. This is what drives markets. So I love the conversation. We live for the conversation. That's what we do. But essentially, we're looking at the fundamentals and we say, it's good that there's a two-way market this year. I like the two-way market because last year when everyone was on the same side of the boat, oh, there's no recession, no hard landing, it's great, Fed's going to cut 7 times this year. There's room for error there, and I prefer investing in an environment like this where Paul, there's back and forth.
Can you see this, folks? On YouTube, you can address this. Alicia Levine, did you get the white blazer from Taylor Swift? Is that? Are you wearing the YSL white blazer today?
I got my own style.
Okay,
yes, there you go.
Continue, Paul.
Alicia, so you talked about earnings coming in strong. It seems like this is a market that has to have earnings because it doesn't seem like the Fed's going to do a lot for us this year. How confident are you that earnings can, in fact, come through this year?
So I think earnings can come through this year. We've seen some degradation in the last week or two. I think this is management saying, we're just not giving guidance right here, right? I think that there's just a reluctance to go all in because nobody knows what the policy is going to be. And so just leaving a little bit of wiggle room for an arbitrage on what size tariff, 10%, 25%, which country. What we'd like to remind our clients and the market is the U.S. has a massive trade deficit with Europe. If there are tariffs, our trade partners suffer more than we do. It's fascinating to me that Europe's outperforming the U.S., by the way, on this. And the question you have to ask yourself is how sustainable is this? Because in the end, we've slowly just increased our imports from Europe and rather than having a trade surplus with them. That's what the market is sussing out. And in the end, the hit to earnings on one round is not going to be that high. Now, if there's retaliation, that's a very different story. But the market's telling you that it does not believe the White House, essentially, on this.
Technology. Is technology going, and the Mag 7, but just broader tech, whether it's chips or whatever, is that going to continue to be the leader in this market? Or is this market, is it broadening out? Does it need to broaden out?
It feels more cyclical to us.
Okay.
So I think that the Mags, look, the top 10 stocks are 37% of the index. Now, everybody's losing sleep over this. It's the most concentrated market ever. You know what? There's more concentration in Japan. Right. There's more concentration in Germany. Okay, so concentration of the top 10 is nothing unusual, nor is it fatal. I do think that there's just a breather here, and some of the some of the multiple has to just sit and have the earnings grow into it because the earnings are still very good.
Alicia Levine with BNY Wealth with us. We welcome you on your commute across the nation on YouTube. Subscribe to Bloomberg Podcast. Alicia Levine has prodigious math skills, which she likes to hide, but the fact is she's got massively outstanding chops. So let's go there right now. When you look at the 4 cross moments, forget about the fancy stuff like kurtosis and the rest. Just look at the variance that creates an intelligent Sharpe ratio, where you're getting a risk-reward payoff 12 months out, 36 months out. To diminish variance, do I want to be less diversified, more diversified? Do I want to do factor or sector analysis, or is it every individual stock for itself?
So I think this is a great year for individual stocks.
Thank you.
Rather than the index. That is a healthy market, right? So that makes for an interesting market. That's the two-way conversation. I think that's where you want to be here, but that doesn't mean you...
Well, no, go ahead, continue, please.
But that doesn't mean you just discard overall diversification. Diversification is the important smoothing out of returns. And we've had clients that said to us last year, why am I even in overseas markets? Why should I bother with diversify, like, ex-US developed? And we said, well, you have to, because the valuation is so extreme that there will be a day where there's some, resolution of this. And you want to be in the market. And the only way to do it is to be in it.
Right. And Paul, what's important here is Katie Greifeld's wonderful story on Vanguard and the index funds. Did you see those numbers?
Yeah.
I mean, everybody's going away from Alicia Levine.
Yeah.
That's all there is to it. I mean, they're all index.
Alicia, how about some sectors if I want to go find some value in the U.S. market outside of technology? What screens well for you guys these days?
So we love industrials. We love financials here. I mean, financials are a really interesting story.
Am I buying JP Morgan, Goldman Sachs, that kind of thing? Or am I...
Well, I can't talk about specific names. So we like overall. I think that the capital providers, the alternative capital providers, they're taking a pause here. There's a reason they rallied after the election, because you're going to see more activity, friendlier face at the FTC. This is all good for financials. Listen, if you lessen the regulatory burden, that sector becomes less of a utility and more of a growth sector again. And then the multiple changes. And in the end, it's not just the earnings moving higher because of it. It's you get a better multiple. And we think that's sustainable here.
Mag 7?
Mag 7 is going to be, well, it's been the lag 7.
Okay, for a cup of coffee, it's been the lag 7.
For a cup of coffee.
You look for 3 years.
So 3 years, yeah. I think
Alicia doesn't drink Sanka. Let's be sure on that. It's Lily. It's like Illy or whatever.
Yeah, it's all those.
European
But look, the Mag 7 needs to at least be in line. In other words, it can't massively underperform the market in order to get to the place where we think the market is.
Is your securities research at BNY Wealth suggesting they will underperform?
Not that it'll underperform. We still think you have massive earnings and massive margins.
And cash flow.
Look, I sat here many times talking about the cash flow margin. So the question is, does all the spending on AI crush that cash flow margin?
Right.
It does on the margin. The market lives in the second derivative. It lives on the rate of change.
Right.
So to that, you could get some just sort of flattening out of performance, but that doesn't mean it's over, and it doesn't mean it's 2000.
30-second audible. Alicia and I bust our chops about education of offspring and that. What's the tip point of $100,000 a year tuition? When do people just say no?
They're not saying no.
They're not saying no.
The market's up 58% over the last 2 years. Real estate's up 45% in the last 4 years. No one's saying no.
Alicia Levine, thank you so much. Absolutely brilliant. Thank you.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We've spent a couple of weeks trying to get him in here. He's with Hartree Partners. Edward Morse is absolutely definitive on hydrocarbons. Think of Daniel Yergin's The Prize. Ed Morse shows up about page 23 in The Prize from a few years ago. Definitive at Citigroup and, of course, now with Hartree Partners. When was the first time you were in Riyadh?
It was in the late 1970s.
With Faisal? With King Faisal?
Yes, but I didn't see him at that point in time.
What is the okay, fine. But what is the strongest difference now between the royalty of Riyadh as they look out at this maelstrom versus our stereotype of Saudi Arabia?
So the Saudis have come a long way. They're looking at how to keep the public happy. They They are trying to diversify their economy as quickly as they can. And it's looking to the future rather than building on the present or the past.
What is their relationship with Russia, this idea of OPEC plus? What's the distinction of that relationship?
The relationship is kind of critical. Think about where the Saudis are, where OPEC is. The Saudis have a production capacity today between 11 and 12 million barrels a day. That's what they had in 1980.
Wow.
1980 was a long time ago. OPEC's production capacity then was around 32, 33 million barrels a day. Today it's 35, 36 million barrels a day. The oil market was then 60 million barrels a day, and today it's 100 million a day. So they discovered that they could not on their own balance the market. They could not put a floor under prices, and they needed to expand. And they had the opportunity to do so in the middle of the last decade when we had volatility across the planet. And a lot of that volatility was a result of the two fastest growing oil producing countries in the world, Russia and the United States. They were looking in the middle of the last decade, actually around 2013, just at the time before Russia had its first invasion of Ukraine, and they saw that the production growth was 1 million barrels a day in both countries. If you look back a couple of years, and they decided to bring prices down. They thought if they could bring prices down to around $70 a barrel, they would see the world lose 2 million barrels a day of oil, and it didn't happen.
Paul, I want to mention this. Everyone was looking for 100, 110, 120.
Yeah, sure.
And there was a lone voice at Citigroup, a bit grizzled. I mean, Edward Morse, a bit older, saying, maybe not. He nailed the move to 70.
So, Ed, how do you think about Russia as a global supplier these days? Because it seems like just in the last few days, things are changing when you think about the Trump administration, how they're viewing Russia. Do you expect Russia to be a bigger global supplier? I'm not sure where that oil went in the first place.
It all depends on when you're talking about, what your horizon is and what could possibly happen. And you have to remember that it wasn't that long ago. It was 2019 when Putin visited Russia, visited Saudi Arabia right after the attack on the Apgate facility, and said, listen, we're going to be cooperating with you through your Aramco IPO, and then we're going to be out on our own. And Sechin, the CEO of Rosneft, said right after that IPO, we're out on our own. We are going to be growing oil production at home and abroad. They have right now the Vostok field in northern Siberia, and that field it's scheduled to produce 2 million incremental barrels a day. They are awash in oil, and they need to do something about it.
So President Trump says, "Drill, baby, drill," and we don't waste time on that. But what we can state with Edward Morse is oil a weapon for the United States in our geopolitics?
Oil is certainly an important part of the foreign policy in the country. It cannot be weaponized other than the degree to which you can put sanctions on a country. I don't know what weaponizing it means. I don't know what we're going to pursue energy dominance means. I know what it means as a soft, powerful instrument of policy. And let me give you an example. We have become the largest exporter of energy in the world, the largest exporter of LNG. That LNG export growth enabled the United States to replace every drop of Russian energy, but particularly natural gas, going into Europe. And it did so at a time when it was able to globalize a gas market that had not been globalized. We have made oil, because we don't allow destination restrictions, we've enabled natural gas to be global, and the price of it is based at Henry Hub in the United States. That's kind of soft diplomacy. We have an ability to expand LNG globally, but it's a soft ability. We have an ability to say multilateral lending institutions ought to be pushing natural gas. They ought to be backstopping regasification. It's cleaner than coal. It's helpful to the global economy. But that's soft diplomacy. It's not using it as a weapon.
So talk to us about the demand side of the equation. I know when you think about some of these commodities like global oil, you really have to have a call on demand. What do you think demand is over the next year or two?
Brilliant question, but even more brilliant. Do you drive an EV?
Got to tell you, I did drive an EV until we moved back to New York full time, and then I discovered that it was too expensive to have a car to deal with actually the rush on garages right at the edge of the zone where New Yorkers didn't want to go south of.
So, coming up, Edward Morse on the congestion tax. Paul, continue with your good question.
So what is your demand view here over the next year or two?
So as we know, there's been a difference of demand views between people in this country, between OPEC and the EIA, OPEC and the IEA. Demand is kind of very simple if you look at it historically. We've had a regular drop in the oil intensity of GDP around the world, starting at the really end of the post-World War II growth of road transport in reconstructed Europe, reconstructed Japan, and in the interstate highway system in the U.S. We've had year after year a drop in the percentage of demand growth per unit of GDP growth. Now, that doesn't mean that oil demand comes to an end. It means it slows down.
Okay.
And to give you an example, if we go back to 1970, 71, for every 1% increase in the world in global oil demand and GDP, there was a 1.2% increase in oil demand. Okay. Today it's about 0.3 to 1. So if we have 3% global GDP growth, we have 1 million barrels a day on a 1% base on a 100 million barrel a day market of oil demand. And that's continuing to slide. So think of it as we're not going to have much more than 1 million barrels a day demand growth.
We are thrilled to have with us today Edward Morse. Of course, you know him from Citigroup at Hartree Partners, now definitive on the geopolitics of oil and also, of course, pricing of oil. Do you have at Hartree, are you allowed to have a Brent guess? Do you have an oil barrel guess, or is it a folk spot?
No, it's not a problem. We live in the most volatile market the world has seen. Based on things that are out of our control. We don't know what's going to happen here and there. It's a relatively evenly balanced market, but for the fact that OPEC, going back to your first question, OPEC Plus has taken so much oil out of the market that it now amounts to 8 million barrels a day. That's a lot of shut-in production capacity that can come on. And if we look at the volatility today, we have prices going up in part because of the drone attacks on the CPC pipeline coming out of the Caspian, bringing Russian and Kazakh oil into the Mediterranean. We have an announcement from Kurdistan, from Baghdad, that the pipeline from Kurdistan through Turkey into the Mediterranean is going to be revived next week. That's gonna we've lost maybe 300,000 barrels a day out of the CPC pipeline. We'll get perhaps 300,000 barrels a day out of Iraq unexpected by next week. So, given that volatility, we think oil is in a range. The range is 68 to 78.
I assume it's gauche, that's French, gauche of you to do buy, hold, sell right now. I don't want to buy, hold, sell on big oil, but how do you position big oil when I see Chevron announcing massive layoffs, massive restructure, and it's weak double-digit return over 30 years. Is big oil prosperous? Is it thriving? Is it the stereotype of our youth?
Well, as we know, some big oil is prospering and some big oil is not prospering. Maybe for some investments that they were making in the past, in the recent past, in the drive to go heavily into renewables and into things that weren't providing the same level of return. But look at the production growth of Chevron, the production growth of Exxon on a global platform based in part on the United States. They're increasing their output. They're increasing their output of oil and gas in a world in which they're very competitive.
Ed, talk to us. I'm watching the television show Landman, about the life in the oil patch in West Texas. So I now consider myself an expert on global oil and gas here. Talk to us about the U.S. We're now a net exporter of energy. What is our role in the global energy market, vis-a-vis, say, maybe like an OPEC Plus or something?
We have transformed the energy markets of the world, including the oil market. If you go back to 2010, we were a gross importer and a net importer, and our production base, if you add NGLs and other liquids, was around 8 million barrels a day. The last month for which we have data, our production of liquids was 23 million barrels a day. We have moved from being the largest gross and net importer of the world to being the largest gross exporter. We export 16 to 17 million barrels a day of liquids. That's more than the combined exports of Russia and Saudi Arabia. Our production is more than the total production of Russia and Saudi Arabia combined. And we've become a net exporter on the order of magnitude of 4 million barrels a day. So that has made the basic difference in the global market. It's a wild difference. It's what gives the U.S. leverage.
I'd love to get you back in here on a 6-month, 3-month basis, Dr. Morse. Let me ask you one final question, and it's sort of from 60,000 feet and philosophical. How bad did Angela Merkel screw up? I mean, within the arch of Edward Morse's tenure, owning the high ground on this, how bad did German leadership screw up from Adenauer forward?
So my personal experience in it is dealing with the effort by Germany to become dependent on Russian gas. So I was in the State Department at the time that the big
serving
negotiations
both Carter and
took place.
Reagan.
And the U.S. and France were the only NATO countries that said, hey, you've got to look at, you Germany, have to look at dependence. Yes, you can import gas, but think about what it will do to your foreign policy. Think about what leverage you've lost in terms of that dependency, your inability to say no. And we saw that over time, and I think Germany has really learned that lesson in terms of being very reluctant as they go through this election process this coming Sunday. Almost all of the parties are reluctant to do more than say we might consider importing oil on a spot basis, but not on a full contract basis.
30 seconds. Does Tesla have a future?
I think EVs have a future. I'm not going to pick one versus another, but they're fun cars to drive. They're cleaner than other cars to drive, and they're getting more and more mileage. So if I were to buy a car again, I would certainly not hesitate to buy it.
There we are, the endorsement we need. Edward Morse, thank you so much. Thank you for joining Bloomberg and Bloomberg Surveillance today. Dr. Morse, of course, there in the tumult, the maelstrom, did his oil today.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul Sweeney and Tom Keene, what we're going to do is talk to Mike Mayo here with Wells Fargo. Mike Mayo is absolutely legendary in banking. He's one of the few people that Congress called upon in the great financial crisis to say, what in God's name is going on? And it has finally paid off. His optimism on large cap banks in Europe and, of course, here in America. I have a chart of Citigroup with a 10-for-1 reverse split, cratering from, down it went, and then it just forever. And finally, a legitimate leg up. Let's start with that, Mike Mayo. Why is banking finally getting a leg up?
Well, the times, they are a-changin'. And you're seeing historic inflection in terms of the revenues, the earnings, and especially 15 years of regulation going from a headwind to a tailwind. Now, I'm not talking about going back to 2006, 2007, before the global financial crisis. I'm talking about preserving the safety and soundness of the banks and eliminating a lot of red tape. And that can help banks operate at a lot higher profit margin to help their stock price.
Is it operational excellence or is it the gift of the yield curve?
It's really more just operational streamlining because regulation has gotten so complex. Pull back that complexity and banks can perform better. But yes, you've had 15 years of financial repression. Zero interest rates were disturbing to banks' profitability. Now you're going back, just back to normal.
So talk to us about how you think the regulatory framework may change and what it can do to returns on equities, for example.
Well, I think the regulatory framework was vastly improved after the global financial crisis. Banks doubled capital They doubled their liquidity. They de-risked for their consumer customers. Remember all those subprime loans? Yep. They de-risked their commercial customers. If anything, banks have been marginalized to the benefit of the non-banks. So a lot of the more risky stuff has gone outside the banking industry. So I would say great job regulators from the year 2010 through call it 2015. But the last decade, you had complexity piled on top of complexity. The living will, the Fed stress test, JP Morgan submits 80,000 pages for each. Jeez. And I talked to the ex-vice chairman of the FDIC. He said he didn't understand it when he reviewed it, and nor did a lot of the banks. So it's a lot of wasted money. So I think you can save a lot of money on expenses at the banks, at the regulatory agencies, and I think some of that gets passed on to the customers. And also, banks deserve to have a level playing field when it comes to how much capital they have. So compute those capital ratios the same way you do for everybody else, and the numbers go up by quite a bit. So this could improve banking returns by 200 basis points over a few years. That's significant, and that can propel a bank stock rally over a few years.
So are there certain banks that are better positioned in this type of environment, or is this a blanket call on U.S. financials?
Well, a rising tide does lift all ships. JP Morgan remains best in class global bank, but my favorite, number one, number two, and number three favorite is Citigroup. I was on your show last year, and it's moved. It's starting to move, but it's still my dominant number one pick. It's a new era for banking, but it's also a new era for Citigroup.
I've got a chart normalized. We're going to talk about this, folks, with Mike Mayo here at Wells Fargo as we go into the next half hour. I got a chart normalized back to the day Lehman collapsed. I think I maybe talked to you that day. I can't remember. I got a JP Morgan moonshot. When you say banks are going to do well, are they catching up with JP Morgan, or is it all boats rising even for JP Morgan?
I'd say both. So I think the lesser banks will narrow the gap with JP Morgan for sure. But at the same time, JP Morgan should continue to improve. Okay. What a bank, generating over 20% returns on 15% capital with some best-in-class efficiency.
Okay, Mike Mayo with this. So I got JP Morgan, clearly way ahead. 317,000 employees is the working number we've got in the DES screen. There's all this, the stuff Chanel Bassick talks about, all this OMG, who's going to take over for Jamie? Does that germane to you? Is that part of your analysis of JP Morgan, or do you just ignore the people moving around and just look at the financials and the execution?
Well, I think Jamie Dimon, I asked him this question in the last earnings call. I said, Jamie, who's your successor? And he didn't give much of an answer. And
He's been doing that for 10 years.
Well, then I finally said, so are you going to be around for a few more years? He said, yes. So I think when you have this many moving parts, Jamie's not going anywhere in the immediate term. Having said that, there's a deep bench at JP Morgan. It could be a number of 3 or 4 different people. Marianne Lake certainly is the name that comes to the fore. Investors know her. She's held a lot of positions. But if Jamie stays on for several years, it's, we'll see what happens. No, I'll say this.
Yeah.
A couple of years ago, I downgraded JP Morgan when they were spending all kinds of money without telling us why they were spending it and everything else. Then I upgraded it, made it my number one pick after the failures from a couple of years ago. But not one investor that I've spoken with, and I've traveled a lot the last 2 months, not one investor that I've spoken with wants Jamie Dimon to leave.
Yeah.
So people want Jamie Dimon to stay right now. And so I think he should get that message and stay. And he's been playing for this moment. I call it re-regulation, not deregulation, re-regulation, making more common sense regulation. And he's going to benefit. JP Morgan's going to benefit. Why leave now? You've been waiting to go to the ball game your whole professional career. You're finally getting there. You're not going to leave before the first inning.
Get one more in.
Citi. I'm a former employee there at Citi. When I worked there, I felt like there's not a piece of business we couldn't win. What happened to Citi, and why is it now your number one pick?
Well, look, compared to the time you worked there was a dramatic shift last year that's underappreciated by almost everybody. They went from 5 decades of this global matrix management structure that nobody understood, and now they have 5 lines of business. They have payments, banking, markets, wealth, and consumer. But they have a CEO in charge of each. They have return targets for each. They have accountability for each one of those 5 lines of business. That's what you're playing for the next 5 to 10 years. But at the same time, they're at that flexion point of the J curve. You invest money and your profits go down. They're turning up on the other side of that J curve where those investments start to pay off and they start spending less. So you're going to see twice or maybe 3 times better efficiency improvement at Citigroup. Right. And return improvement at Citigroup than the other banks. And by the way, they're passing this magical line where they have single-digit returns to double-digit returns. When you do that, you go from value destruction to value creation. That is the number one biggest driver of bank stock performance. It's the number one big bank stock performer so far this year. I think it'll be the top performer by the end of the year.
Michael Mayo with us there on Citigroup, and we'll continue. He is, of course, large cap bank research at Wells Fargo. Fairly to say, legendary industry. Also very cut and chiseled.
Yeah.
He's like, he said to me, Tom, you got to hit the weights again.
Got to hit the gym, Tom. Come on.
He's like, Tom, get in the gym. So, thank you, Mike Mayo.
On your Citigroup pick, I'm fascinated by this. Now it's all coming back to me. I walked out of the door of Citi after a few years, sold all my stock literally on the day I walked out the door.
Very cool.
In January of 2000. Jane Fraser, I think she's got a pretty good message for the street. How is she different from other CEOs at Citi who have also promised change and to clean things up and to streamline things?
Oh boy, you're triggering me right now. So I think of the other CEOs. If it goes back, Tom Keene probably remembers Walter Wriston, right? Countries don't go broke.
My father knew him personally. They used to talk farms and all. He worshipped Walter Wriston, and then it ended.
Yeah, let's lend to Latin American countries. They'll pay us back. They did in 1987. You had big charges. Then you had John Reed back in the early 90s. He had the Saudi prince, had to pump it up with capital. And then you had the whole Sandy Weil era that came later. Yep. And then you had long-term capital with the problems. And I call that Noah's Ark because they brought 2 of everybody along with the big mergers with Travelers. And then you had Vikram Pandit, which first you had Chuck Prince, the lawyer. Yep. And remember, he's going to keep dancing until the music stops. And that ended very poorly.
Then the music stopped.
And then the music stopped, and basically they effectively failed, and the government bailed them out. And then you have Vikram Pandit, which was kind of there. And then you had this guy, Mike Corbat, who didn't change the strategy at all. And through it all, I'd say Citi was very arrogant. Very arrogant. Jane Fraser gets there and says, you know what? We have a lot of problems. We have a lot of things to fix. The first step is to recognize that you have a problem. And it's taken her a little bit longer than some people would have liked. I understand that. And the expenses are a lot higher than they should have been. Right. But recognizing a problem. Then last year, everyone said Citi's going to mess up. 3 concurrent initiatives. One is this org simplification. They went from their 5 decades of matrix structure, 5 lines of business. They eliminated 5 management layers. They told all the employees you're going to have to manage more people. It was gut-wrenching, and they fired some people, and that's always tough. And then you have they're divesting, over a dozen consumer operations in a dozen countries outside the U.S. And then they have this transformation, the back office. They're doing this all at once, and everybody said Citi's going to implode. Well, guess what? Last year, Citi met its efficiency targets. They beat their revenue targets. They met, and so going through those major changes. So people say, what's the proof? What's the evidence? Look at the results of last year and their guidance. 3 years in a row, they're now guiding, if you believe them, revenues going higher and expenses going lower. So you're at that huge inflection point now. So they're recognizing they have a problem. They don't have that same degree of arrogance. They have the ability, they have the capability. They're in 100 countries. So if you're a global multinational corporation, you want to do payments or global investment banking, you got it.
Right.
They're top 3 in credit cards. So they have the franchise, a new strategy, and Jane Fraser as the ultimate architect of where Citigroup should be the next decade.
You are more qualified on this than anybody I know on the sell side. The great group of sell side analysts that are out there. Jamie Dimon this weekend was the talk of the weekend with some tape that was, out of JP Morgan and that. Mike Mayo on work from home.
I loved the Jamie Dimon video, the audio that got leaked out to the press, and that's vintage Jamie Dimon.
It is. I agree with that.
He just said he's going to say what he thinks, and he says, if you don't like it, don't work at JP Morgan. We want you to work at JP Morgan, but if you You need to work in the office so you can mentor people and everything else. And for JP Morgan and Jamie Dimon, that works, and that's their strategy.
Come on, when you were at Credit Suisse, you had mentors as you built your career. You went from, the day you got canned at Credit Suisse, I think I spoke to you that day or the day after, whatever. The answer is you need mentors. Mike Mayo on Work From Home. Talk to the kids right now.
But I'd also say it's not one size fits all either. Okay, so there's different departments at different banks.
Different departments, but come on.
Different departments, different banks. I will say, though, Jamie Dimon and JP Morgan, it's worked for them. They came back early during the pandemic. Goldman Sachs, that was actually my first meeting at Goldman Sachs. I wasn't going to go in. My wife's a doctor, as you know, and she says, no, you're going in to meet with them in person. Okay, and I went to Goldman Sachs, and I'm telling you, they have this middle area where you have to transfer to the upper floors. And it was almost packed, and this was at a time no one was going back to work. So the J.P. Morgan and Goldman Sachs, they had they had so many employees back early, and look at the most successful, best-in-class firms.
You want to weigh in on this, Paul? Paul gets fired up.
But it's not one size fits all. So if Citigroup decides they're going to allow some people to work remotely, that might be a competitive advantage in hiring certain people. So I'm saying
computer people. I get it.
Well, just sometimes you can get great people if you make some accommodations. So Jamie Dimon's not of that,
No, we got Lisa Mateo. I mean, that's the way it works.
Hey, Mike, talk to us about Bank of America. Again, a former employee through Merrill Lynch. I've worked pretty much everywhere. Talk to us about the Bank of America story. Sometimes that gets lost a little bit between the Jamie Dimon talk and maybe the turnaround at Citi. What's the story at Bank of America?
Look, we have 3 words that sum up the largest banks. That is, Goliath is winning.
Okay.
Scale is making more difference in banking than ever before in the history of banking.
Why don't you tell the European regulators that? I mean, because they've lost. They've lost.
Absolutely lost. The 5 biggest U.S. capital market players, Bank of America, J.P. Morgan,
Goldman, Morgan Stanley.
Morgan Stanley, and B of A.
Yep.
They've gained market share in capital markets since the global financial crisis, in spades, and I think they'll continue to do so. And talk about twice or 3 or J.P. Morgan 4 times larger than the European bank peers. And by the way, this whole idea that U.S. banks should not merge, that's like the Brian Moynihan or Jamie Dimon Protection Act. Right. Why do you want to protect them? You should have more large banks. PNC, Bill Demchak talks about wanting to have another $1 trillion bank. He'd like to be that. But the unintended consequence of regulation for the last decade.
30 seconds. Do you have a regional right now you would own around that Mike Mayo theory? Do you have a regional that could be mergeable with the people from Pittsburgh with their beautiful baseball park?
Look, if you want a name to own, it's Citigroup, it's Citigroup, it's Citigroup. I don't want to dilute that call.
But it's a compliance risk.
We're waiving all portfolio limits, okay? But it's really Citigroup, and then look, and J.P. Morgan and Bank of America. Those are the 3 Goliaths. They benefit.
You're not even going to look down in Gerard Cassidy's territory.
Look, PNC is a quality bank. They're the national Main Street bank. They're in the 30 largest cities. They have a 10-year runway. Bill Demchak is an exceptional CEO. And they should have revenues growing far faster than expenses, and they'll benefit from the rising tide that lifts all ships. But again, for me, it's Citigroup is my primary recommendation.
Mike Mayo, thrilled to have you in today. Thank you so much. He's with Wells Fargo, folks.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
The daily look at the front pages, the Lisa Mateo moment. Lisa, what do you have today?
All right. Well, we know President Trump has been warning of steep tariffs on European goods. So the Wall Street Journal has this interesting article because they're saying it's going to be a blow to Bernard Arnault's LVMH empire. So they go into the connection between the two because they say he's trying to kind of work those ties to try and avoid the tariffs. They do. Back when they were up-and-coming property developers in Manhattan. The families know each other. You have Arnault's second oldest son is friends with Jared Kushner. You have Ivanka, friends with Arnault's daughter. Arnault was at the inauguration ceremony.
They're just friends because they want a bag. I mean, Ivanka goes goes, I'll take that one.
Not too bad.
Well, Rich Go has Bernard Arnault, number 5, 196 billion.
Ooh.
So that's good for him.
It
They
does.
got some real challenges right now, though. I mean, I believe
They do, because China's
China,
sales
right, yep.
fell. Yeah.
China, and there's some other issues as well. And the real angst here, which I read in Le Monde in France, is they've basically businesses had it in France with the taxes. And the real relationship here is Arnault's bait to put manufacturing in Texas.
Oh.
And, I don't know what products,
Right.
not Tiffany jewelry, but something.
Interesting.
Manufacturing. And I mean, do you want to buy a Louis Vuitton bag that says "Made in Texas" on it? Does that take the charm away,
It does
Lisa?
take it away. It does.
Next.
It does. Okay. We'll stick with kind of luxury. The Neiman Marcus century-old flagship store in Dallas, you mentioned Texas, it's going to shut down.
Really?
The owner of Saks Fifth Avenue made the announcement. Okay, so what stands out is because it comes after they just announced that they were acquiring Neiman. This big merger happened in December. The store apparently going to close March 31st. It was in this memo from Saks Global. It was seen by the Post. So they received a notice from the landlord to terminate their occupancy. It doesn't have to do with acquisition, the source is saying. It's saying it has to do with kind of a tiff with one of the building's multiple landlords over a certain piece of property. The corporate, offices above will stay there, but the store will close.
Dallas is a booming market. Well,
Yeah.
Texas is
Yeah.
booming overall, wow.
There's good morning to all of Chestnut Hill in Boston and the Smith family at General Cinema. That was the glory years for needless markup. And what, Richard Smith, and his kids did there. They really husband the image forward. And I don't know how many owners it's been through since General Cinema had them, but the answer is it's a whole new world. I don't get department stores. Do you, Lisa? Do you spend a lot of time?
I don't know.
I mean,
It's too overwhelming for me.
Costco's not a department store, right?
No, definitely not.
Okay.
They have limited selections, which I like. Okay, so not sure if any of you have either had overhead bin experiences that are just gone wrong on an airplane before.
Third rail with
Okay,
me.
so apparently there's this battle for the carry-on space. I've seen it. People shove their bags in there, try to fit it. You have the other people who kind of toss it in, first class or economy plus
Yeah.
before they hit the back.
Good
They
strategy.
kind of do that too. It's delaying the process. So people are complaining. So the Wall Street Journal came out with the proper etiquette and what the rules are and what you're supposed to do. So you're supposed to put the larger carry-on in the overhead bin, the smaller item under your seat, because a lot of people
not
take
happening.
the smaller item. See, there
See,
you go.
yep.
You're one of them.
Yep.
You put the smaller bag in the overhead bin, don't you? That's what you do.
Yeah, well, what I've noticed, even on a 737, all the overhead bins have been refurbished, so they're much bigger. So your big roll-on thing doesn't lie flat; it lies on its side, and you can get more of them in there. So they've actually, I think, improved the whole overhead thing because they know
They have.
nobody's checking bags because that's a disaster.
I don't know where the airlines are. And the whole thing's solvable in one day. That's the thing I don't get. It's like we all have problems. Like the Red Sox, middle relief is a problem. Baggage on airplanes is not a problem. Lisa Mateo with the newspapers. Thank you so much.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.